Ever wondered how investors determine what a company is really worth? The discounted cash flow, or DCF, method is one of the most powerful tools to find undervalued stocks before the market does. Stick around till the end for a pro tip on avoiding common DCF mistakes. DCF valuation is all about forecasting future cash flows and adjusting them to today's value. Let's break it down into simple steps. Let's start with the process. The first step is to forecast free cash flow, or FCF. To do this, we estimate a company's free cash flow for the next 5 to 10 years. Free cash flow is the real cash a company generates after covering its operating expenses and investments. Free cash flow is calculated by subtracting capital expenditures from the operating cash flow. You can find this information in the company's cash flow statement. A pro tip: use a growth rate based on historical trends, industry outlook, and the company's competitive advantages. The second step is to determine the discount rate. Once we have the free cash flows for a period of 5 to 10 years, we can't just sum them up. Since money today is worth more than money in the future, we need to adjust these cash flows to their present value. This is done using a discount rate, which is usually the weighted average cost of capital, or WACC. WACC represents the company's cost of financing, both through debt and equity. The cost of debt is the interest paid on loans, preference dividends, and debenture interest. The cost of equity is the expected return for shareholders. To calculate WACC, we take the percentage of equity in the total capital, multiply it by the cost of equity, and add it to the percentage of debt in the total capital, multiplied by the cost of debt, adjusted for tax benefits. A pro tip: higher risk companies should have a higher discount rate to reflect uncertainty. The third step is to calculate the terminal value. Since companies don't just stop operating after 10 years, we use a terminal value to estimate their worth beyond the forecast period. There are two ways to calculate the terminal value. The Gordon growth model assumes a steady growth rate, typically based on inflation plus GDP growth. The exit multiple method uses industry benchmarks, such as the enterprise value divided by EBITDA. Using the Gordon growth model, terminal value is calculated by taking the free cash flow of the last forecasted year, multiplying it by 1 plus the growth rate, and dividing it by the difference between the discount rate and the growth rate. The fourth step is to sum it all up. Now, we add up all the discounted cash flows and the discounted terminal value to get the company's intrinsic value. The enterprise value is simply the sum